The stock market has been selling off big time over the past few weeks, and it can start to hurt investor psychology. For example, you may see your overall portfolio down in total value, and some of your stocks crossing over into the red again. However, this is just a market correction, and it can get a lot worse than that. So it's important to keep your long-term focus. That's why today I thought it would be a good idea to share companies that are raising their dividend payments. Even though many of the stocks you own may have seen their price come down over the past few weeks, the real businesses behind the stock continue to grow. And there are many companies that keep growing their dividends. And not only are these companies making more money, they continue to increase the dividend payouts they give to shareholders. Today, I'm going to share my top 10 most notable dividend increases I saw over the past few weeks. These are high-quality companies with strong fundamentals that pay growing dividends over the long term. So with that said, let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Now you may have noticed these beautifully formatted dividend raises, and if you want the latest dividend increases sent to your email inbox every single week, then sign up for the dividenddata.com newsletter. You can join for free, the link is in the description and pinned comment of the video. For stock number 1, I'm going to share the American Express Company, ticker symbol AXP. They just announced a 17% dividend increase, bringing their quarterly dividend payment to 82 cents per share. And as you can see, this continues a long history of dividend growth at American Express. Their dividend is growing at a 10-year compound annual growth rate of 12.17%. The current starting dividend yield is 1.23%, and this is a sustainable payment with very low payout ratios. The free cash flow payout ratio was 14% based on fiscal 2024 and 19% based on net income. The company also consistently returns capital to shareholders with share repurchases, and this has been a great long-term performer. As you can see, a lot of this has been backed up by high earnings per share growth, and that allows for this growing dividend payment. And over time, that should increase the stock price as well, as a company's valuation is determined by the discounted value of all the future cash flows and earnings it can generate. Now, what I will say is that their dividend yield is historically low, and in the past few years, you could have bought into the stock at around a 1.6% yield. This is a classic example of a dividend growth stock, though the total return has been very good. Since 1990, the company's had a 5,000% total return, and the 5-year total return is 231%. Another company that just increased its dividend was Domino's Pizza, ticker symbol DPZ. As you can see, this is a company that has consistently grown its earnings over time, and the stock price has done pretty well. They've been a consistent dividend payer, and since 2013, they've been increasing that payment on an annual basis. Their most recent increase was 15.23%. That makes the quarterly dividend $1.74 per share. On a forward-looking basis, this now gives the stock a 1.64% dividend yield. And once again, this quarterly dividend is sustainable. The 10-year compound annual growth rate of Domino's dividend is 18.83%. And this is sustainable too, with a 41% free cash flow payout ratio and a 35% net income payout ratio. So the Domino's dividend keeps growing. And once again, that's because the business of Domino's is growing. And if we look at the dividend yield for Domino's, you can see that it has varied over time, but it's always a pretty low yielding stock. That's because of the faster growth. So based on the past 5 years, we're still in that upper quartile in terms of dividend yield. Since going public in 2004, this stock has had a 6,900% total return. The price hasn't done as well in the past 5 years, but now it becomes a more interesting valuation. The 5-year total return is 57.5%. For stock number 3, I have Dick's Sporting Goods, ticker symbol DKS. This is a highly profitable company that saw a big surge coming out of the pandemic, and they've been able to maintain pretty high profit levels. If we look at their stock price, they have sold off a bunch since this January, but in the grand scheme of things, it's still up a lot since 2020. Now, what's interesting is Dick's Sporting Goods is becoming a dividend growth stock. Their most recent dividend increase was 10%, boosting the quarterly dividend to over $1.21 per share. Their prior increase was also 10%, and the one before that was 105%. They even did a big special dividend in 2021. But with this base quarterly dividend, the forward-looking dividend yield is 2.49%, so it's the highest yield of the 3 stocks I shared so far. The 10-year compound annual growth rate of the dividend is 24.32%, The free cash flow payout ratio based on last year was 71%, which is trending upwards. I'm going to have to take a look to see how their free cash flow trends look for the coming year. Their earnings per share payout ratio currently sits at 31%. They are currently at the lower end of their dividend yield over the past 3 years. Since going public in 2002, this stock has done very well though with a 7,000% total return. And this has been a surprising winner coming out of the pandemic with nearly a 1,000% total return. That has slowed down a lot though. We're at around an 87% 3-year total return. For stock number 5, I have Oracle Corporation, ticker symbol ORCL. This company has had very good earnings growth really since 2017. And their stock price has gotten pretty nutty lately with this whole AI boom. But now they've sold off quite a bit coming off the top. And Oracle's an interesting dividend company. They do pay quarterly, but they have a pattern of increasing it every 2 years rather than every year. However, those increases come even larger. For example, they just did a 25% dividend increase to 50 cents per share. That makes the forward-looking annual dividend $2 per share, giving it a 1.34% dividend yield. This puts their 10-year compound annual growth rate of the dividend at 15%. It is sustainable too, with a 37% free cash flow payout ratio and 41% based on net income. Even with this recent sell-off, the dividend yield for Oracle stock is still pretty low. There were years where you could have gotten this in the 2% range. But over the long term, this stock has been a huge winner. Since 1990, it's had a 34,000% total return. The 5-year total return is still even pretty good at 276%. And again, to emphasize, on a long-term horizon, a growing business will mean growing dividends and a great total return for investors, assuming that you did not buy in at a crazy high initial stock price. For example, with Oracle, we can go back and in the dot-com boom, the price was as high as $46 a share, and that stock price was not seen again for 15 years. However, if we look at a direct comparison here, earnings per share grew from 16 cents per share to 92 cents per share in that exact same time. So the company grew earnings nearly 6 times. So your initial purchase price definitely does matter. And by the way, if you want to use all of the tools I'm showing today, including the stock analysis and the AI analyst I'm using to get these dividend yield charts, all of that is available at dividenddata.com. Now is a great time to join, and you can lock in 50% off our annual membership and lock in that discount for life. There is no risk in trying it out. We have a 30-day money-back guarantee. The link is in the description and pinned comment below. For stock number 5, we have Applied Materials, ticker symbol AMAT. This is a semiconductor equipment and software company that has had fast growth in recent years. Really, since 2015, their earnings per share has taken off with a few dips along the way, and they just recently hit all-time highs in earnings. However, if we go and look at recent stock price performance, they are down a bunch from their all-time high in stock price. And if we look at the AMAT dividend, it is growing very fast. They just had a 15% dividend increase, bringing the quarterly dividend to 46 cents per share. On a forward-looking basis, this puts us at a 1.18% dividend yield. The 10-year compound annual growth rate of the dividend is 16.49%. This is wildly sustainable with a 15.9% free cash flow payout ratio and a 16% earnings per share payout ratio. And once again, this is another company that does share repurchases as well. Despite this dividend growth though, the stock price has gone up a lot in valuation over time. During 2018, you could have gotten the stock at a 2.5% yield, and in the early 2010s, you could have gotten as high as a 3% yield. However, it's difficult to go back in time because if you were to look at the earnings from that point, you would have thought that this was a no-growth company. It was flat for decades, and semiconductor equipment is a highly cyclical business as well. It is entirely based on the industry spending at that time. And the semiconductor market itself historically is cyclical in many markets. However, if you identified it at that time, you would have made a killing. Since 1990, Applied Materials has a total return of 47,700%. And that's with it down negative 21% over the past year. The 5-year total return currently sits at 302%. So even though the stock price is coming down, the actual business of Applied Materials continues to grow, at least so far. For stock number 6, we have ROST Stores, ticker symbol ROST. This may seem like a boring retail company, but they have had surprisingly fantastic results. I mean, look at the earnings per share growth here, and the stock price has done very well. They also have sold off a bunch and are at their lowest price since late 2023. ROST is a dividend growth stock as well. Look at this dividend chart. It's pretty fantastic. They did suspend the payment though in 2020, which makes complete sense. But they brought it back and have kept growing it since then, and the most recent increase was 10.2%. This brings the current dividend yield to 1.3%. The 10-year compound annual growth rate of the dividend is 13.17%. And it's a sustainable dividend too, with a 29% free cash flow payout ratio and 23% earnings per share payout ratio. So this company has a lot of room to continue growing the dividend over time. ROST Stores also buys back a lot of stock. Based on how I feel about ROST Stores in the real world, I would think the company was doing terrible. Since 1990, ROST Stores stock has a total return of 36,800%. However, that has slowed down lately. The 5-year total return is only 75%. But with this recent sell-off, the dividend yield is higher than much of the past few years. It's really only other than 2022. For stock number 7, I have Booking Holdings, ticker symbol BKNG, Booking.com, Booking.yeah. You've probably seen that commercial. This company has been a fantastic long-term compounder. Their really only weak period was during the pandemic, which makes sense because travel was down significantly. And even then, the business was so robust that the stock didn't even sell off that much. I mean, that was a big dip, but in the grand scheme of things, you would think that it could have gone even lower. And since then, the stock price went to all-time highs, and so did earnings per share. And they became a new dividend payer as well. The company just had their first dividend increase with a 9.71% increase to $9.06 per share. That makes the forward-looking annual dividend $38.40 per share, and we're still operating in a very sustainable range with a 19% EPS payout ratio and 14% free cash flow payout ratio. The current dividend yield is 0.86%. So the dividend is a small percentage of their current cash flows. This company also does repurchase a lot of shares, and I'll tell you what this chart tells me. Booking is a growing business. Since going public in 1999, the stock has an 800% total return, which does not seem that good, but the stock was very overvalued when it went public. As you can see, in 2009, it was still down negative 85% from that IPO price. So again, guys, price does matter with these things. The 3-year total return is 105%. And they don't have a lot of history when it comes to dividend yield since it's a new payer. But with the recent market sell-off, it is the highest dividend yield since September 2024. For stock number 8, we have General Dynamics, ticker symbol GD. This is one of the large, reliable U.S. defense contractors. They've had steady earnings per share growth over the past few decades. The stock price has largely followed suit over the long term, although there have definitely been dips along the way. The company also has a multi-decade history of increasing their dividend payment. They just announced a 5.63% dividend increase, bringing it to $1.50 a share. That makes the forward-looking dividend payment $6 per share, and at today's stock price, that's a 2.29% dividend yield. Dividend growth did slow down a little bit compared to the prior increase, and it is below the 10-year compound annual growth rate of 8%. That said, the payment is sustainable. The current free cash flow payout ratio is 47.84%. The EPS payout ratio is 40%. So this is one of the higher yield dividend growth stocks I shared today. This dividend yield, though, on a historical basis is still on the lower end, although it is higher of much of what you could have gotten in 2024. Since 1990, General Dynamics has had a 9,500% total return. The 5-year total return is 133%. For stock number 9, I have the TJX Companies, ticker symbol TJX. And this is another one you think is a boring retailer that, in my mind, I didn't think it was that successful, but they are huge and they are growing their earnings per share, and the stock price has done fantastic. TJX is still a growing company, and they are a dividend growth stock as well. They announced a 13.3% dividend increase, which is not yet reflected on dividenddata.com, so hopefully that comes in the next few days. And that will increase the forward-looking dividend to $1.70, so the dividend yield should be a little higher, maybe 1.5%. The 10-year compound annual growth rate of the TJX dividend is 15.67%. It is sustainable with a 34% free cash flow payout ratio and 33% EPS payout ratio. The company also buys back a lot of stock over time. This company has just been a compounder. Since 1990, it has a 37,000% total return. That is nuts. The 5-year total return is 194%, and the current dividend yield on a historical basis is pretty low. It is higher than much of 2024, but it's still low in the grand scheme of things. But hey, that might not matter that much if TJX keeps growing. And then finally, for stock number 10, I picked a favorite among dividend investors, and that's Realty Income Corporation, ticker symbol O. And the reason why this is a favorite is that this is known as the monthly dividend company. As you can see, they pay a dividend every single month, and they slowly increase it throughout the year. And they just had a 0.2% dividend increase, and last month they had a 1.52% dividend increase. This is also the highest yielding stock I have on the list. It's a 5.68% dividend yield. This is a real estate investment trust, and it is sustainable based on their free cash flow. And as you can see, their earnings have grown over time. But their stock price has not done as well lately. Some dividend investors have started to fall out of love with the company because they haven't done that well over the past 3 years. Total return's only 1%. The past 5 years, it's 38.5%. However, on a historical basis, this has been a compounder in the market with that nice monthly dividend that grows over time. So the total return since 1994 is actually 4,200%. And again, this one is much more focused for income investors. You get that nice 5.6% dividend yield. And if you're looking at buying it for that income right now, this is high on a historical basis. But the main point of today's video was to take a step back from all the stock price market action of the past few weeks with the sell-off and refocus on the underlying businesses you're investing in, many of which will continue to grow over time, and they're growing their dividend payments. If you want to use the stock research tool I showed throughout the video, including the AI analyst and your own portfolio tracker, all of that is available at dividenddata.com. The link is in the description and pinned comment of the video. You can get 50% off the annual membership if you join right now. So if that sounds interesting to you, now's a great time to join. With that said though, thanks for watching and I'll see you in the next video.